Dear viewers, since for last about 6 to 8 months, we hear a terminology called SIF in investment. Is it a new asset class? What is that? Is it interesting? Is it risky? Is it rewarding? Who should use it? Who should not use it? It's a subject by itself. So this episode is dedicated to understand what are SIFs, and I'm going to talk to an expert, Mr. Niranjan Mujumdar from SBI Mutual Fund, to get all the information you are looking for. This is NRI Money Clinic for you, and I am Dr. Chandrakant, but your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Dear viewers, to talk about the SIFs, I have a very expert speaker today, Mr. Niranjan Mujumdar. Mr. Niranjan Mujumdar is the Senior Vice President at SBI Funds Management Limited. He has been working with SBI Mutual Funds since March 2004. He comes with 28 years of experience. Professionally and academically, he holds a Master of Commerce (MCom) in Advanced Accounts and an MBA in Financial Management. He is a certified financial planner and has successfully passed Level 2 of the CFA program. Welcome to this episode, Mr. Niranjan.
Good afternoon, sir. Thanks for having me on this show. Good afternoon, viewers.
Sir, SIF is creating a lot of curiosity amongst our viewers, and lots of messages have come to do a video on to understand every aspect of SIF. Now you have to get down to the level of the common man and try to explain this complex SIF so that everybody can understand. I'll also ask you very simple questions which are there in the minds of the viewers.
Okay, sir.
So please help them understand so that the right audience can work on the SIFs. My first question to you is, what is SIF? Who should use it? And what's speciality about it?
Okay, that's great. SIF is called as Specialized Investment Funds, and this is a new category introduced by regulator SEBI to bridge the gap between mutual funds and portfolio management services. Because as we evolved, we started seeing how our journey began in the era of 1990s, wherein only a traditional investment instrument like fixed deposit used to take care of all investors' need. Eventually, industry started evolving. People started looking out for better post-tax return on their investments, and as the rate started cooling off, people started hunting for a different investment avenues. So the income generation journey evolved. It started migrated from a traditional instruments to products like fixed income mutual funds and all. And eventually, we saw a massive bull run. We saw global financial crisis, but eventually that again got the interest rate further down, and people started moving from income generation to wealth creation. And in the journey of wealth creation, equity became a very critical asset class in every investor's portfolio. But as things evolved, people started moving from a traditional equity investment to a typical asset allocation products. That's the reason products like balance advantage fund, multi-asset allocation fund, they picked up. And eventually, as things matured, there was one space which was still not getting addressed in the fullest way. That was typically about the risk management. So that's the reason risk management from both the sides in terms of mitigating risk as well as enhancing the risk. So derivatives are one of a very critical tools which can help in investors' portfolio to mitigate risk as well as enhance risk. So the focus on risk management increase, and risk management tools which can offer you a flexibility of products like AIF, but with the tax efficiency of mutual fund. That was something which came into a limelight through the products which are called as specialized investment funds. Now, the specialized investment funds, only a registered mutual fund house can launch a SIF product, because every SIF product comes with an investment strategy, and these are basically a mutual fund. The name investment strategy for SIF is typically nothing but a mutual fund scheme. So only a registered mutual fund house can launch SIF prior to fulfilling certain rules and regulations. So this was really about SIF, which has come into play to address the gap between mutual fund and PMS and AIFs.
See, viewers are spoiled for choice today. You have the mutual fund, you have SIF, you have the PMS, you have what AIF. This is in and around the stocks as such. How do you differentiate it and how people can figure out what exactly is the difference between these different terminologies or different assets which are available for them to pick from the market?
Okay, sir. So basically, we all know about mutual funds. Mutual fund is typically a product wherein for lump sum investment, you need a minimum investments of around 5,000 rupees. When you move to PMS, you move from a pooled asset to a customer tailor-made portfolio. So there, the minimum investment moves to 50 lakh. And when you move to alternate investment funds, AIFs, the minimum investment amount goes further up to 1 crore. So SIF is something which is in between mutual fund and PMS. The minimum investment amount for a SIF strategy is rupees 10 lakhs. And then the biggest advantage of SIF is the taxation. Because, say, for example, if you come up with certain investment strategies, say, typically a long short strategies in products like AIFs and all, derivative income is treated as a business income, so it's taxed at a marginal tax rate. So, whereas for a PMS, every trade which is done in your demat account, that every trade, whatever capital gains and all are generated, your tax liability incurs based on all those transactions at a transaction level. But when it is a mutual fund, your tax liability is generated only when you exit or redeem or switch from the investment strategy. Whatever fund manager does in the portfolio, that doesn't matter your that doesn't have any tax implication on your portfolio. So on a post tax basis, this is a very classic tool because it can give you a flexibility of what AIF products can offer you, but it gives you a tax incentive which a mutual fund scheme offers you. The other critical difference is typically on the expense ratio. The expense ratio for SIFs are typically the way they are there for mutual fund scheme. Everything is same as compared to products which are like PMS and AIF, wherein certain times you have management fee, performance fee, profit sharing and all. But this structure is typically the way you have it for all your mutual fund scheme. And the biggest advantage what SIF gets over mutual fund scheme is basically a use of unhedged derivatives. Now, when you invest in a mutual fund schemes have certain restrictions in terms of use of this derivative. Say, for example, mutual fund schemes, if you want to do a covered call, you can do to the tune of say around 15% of your equity exposure, whereas in SIF you can do a full 100% of your portfolio, you can equity exposure, you can do it with a covered call. SIF, the biggest advantage of unhedged derivatives, which is not available in mutual funds. Mutual fund cannot take any naked short positions, but SIF up to 25% of your portfolio, you can use unhedged derivatives in SIF. So this is the biggest differentiator what SIF comes with other products which are typically a mutual fund, PMS and AIFs.
When you talk about SIF, it's all about different strategies which can get into it. Can you take us through what these strategies are? Is it one asset class? Is it multiple asset class? Or it's just the derivatives? How the functioning happens in this with respect to the strategies?
Okay, so SIF basically every fund house gets a flexibility to launch 7 different strategies under SIF. 3 strategies in equity categories, which are typically equity long short funds, equity X top 100 long short funds, and sector rotation long short funds. 2 strategies under hybrid categories, which is hybrid long short fund, asset this active asset allocator long short funds, and 2 strategies under fixed income category, which is typically a debt long short fund and sector debt long short fund. So these are 7 different strategies SIF can come up with in our new regulations.
See, mutual fund industry already has several products which are meant for managing the risk. See, you have this balance advantage fund. Then to control the exposure to different asset classes, you have the multi-asset allocation funds. Then you have different categories of hybrid funds with equity exposure control, conservative hybrids, regular hybrids, and kind of a thing. So, how the strategies that you adopt in SIF are different from the strategies which are available in the different mutual fund schemes?
Okay. So every investor has a different needs, and every investor invests with certain expectations. So typically, person who is migrating, who is looking for today's era, we have seen fixed income rates have come up significantly. Even debt funds, YTMs have come up significantly. Hunt for a post-tax return has increased because there were a lot of tax incentives which were there have gradually been reduced or removed. Say in 2018, we saw long-term capital gain tax introduced in equity. After March 23, we saw biggest indexation benefit which was attached with debt scheme. Today, for a debt investor, there is no indexation benefit. So, for an investor, what matters is not only the return what he generates from his investment, but what matters more is what is the post-tax return which he generates from his investment. So, when he's looking out for some better post-tax return, and in today's era, when fixed deposit, debt funds, everybody have their carry on them have come up so significantly at a lower level. Hunt for that pushes investor to look out for different investment avenues which can have a potential to deliver better post-tax return as compared to fixed income product. But simultaneously, the other side of it, because if you go to chase returns, then what comes along with return is basically a risk in your investments. And risk, the major part of risk gets defined through volatility and drawdown. So how volatile would be your portfolio and what would be a maximum drawdowns in case of correction. So any product wherein investor can migrate from typical fixed income to a long only hybrid funds or equity funds, but during the migration phase he is expecting something better than fixed income on a post-tax basis, but doesn't want to face volatility and drawdowns which can come in a long only hybrid funds or equity funds. So the gap which used to take place in this expectation, that sits fully with one of the strategy which is there in the SIF bouquet. So this is typically how SIF can help investors in building their portfolio. It can help them to ladder their portfolio. A strategy like hybrid long short funds, if it is well articulated, it can fit in between fixed income and arbitrage. It can fix just above arbitrage, below long only hybrid funds.
So it's getting complex. That means the industry, through the different regulations, are discovering these new kinds of products to meet the customer's need to generate that return. So, in a ever falling interest rate scenario, or the markets becoming stagnant, and how they can build this return, this is something what the general public is always looking for. Probably that's where the SIFs can cater to. One question that lingers on my mind is, can people latch on to SIF as a blanket case? Every person who comes into the investing world, can he come and latch on to SIFs after hearing this video? Or is there a specific set of people who should avoid or who should look at SIF as a possible option?
The biggest advantage with SIF is SIF can be used by a wide universe, like even HNI investors, ultra HNI investors, family office, institutional investors. This is a product which can suit the investment need of multiple people across the ladder. But during SIF, one bigger what critical thing which should be seen in SIF is what sort of a strategy which is getting implemented in the product wherein his or investor is going to invest. Because unlike mutual funds, wherein a lot of products, say for example, a typical large cap fund, the universe for large cap fund is top 100 companies in terms of market capitalization. You have to have minimum 80% of your investment in top 100 companies in terms of market capitalization. So most of the large cap funds would be more of a homogeneous product. But when you look out for a SIF strategy, the use of derivative can work in a totally different way. Like in the hybrid long short space, there would be some product which could be running typically on a equity taxation basis. There would be some product which will have more of a fixed income into it. Some product may be using derivatives in a much more aggressive way. Some product would be using derivatives to mitigate the risk. So those products will be more conservative products. So for an investor, it's very critical to understand before investing about a strategy wherein he's going to invest his or her money, just to first to get acquainted with what sort of a risk return trade-off available with that strategy and where it can suit in my investment. Okay. So this is typically a critical aspect of investing in SIF.
From the information what you gave, so there is a lot of due diligence which gets involved before you invest in SIF. So while it looks attractive, but the detailing which goes into selection of SIF looks bit complex. Are these SIFs can be recommended by each and every mutual fund advisor or do-it-yourself investor, or there are special qualifications which are required for person to suggest SIF schemes for the investors?
So for any advisor who's going to, or any distributor who's going to market SIF products, they have to pass an NISM certification, which is NISM 13 exam, for them to get qualified in this space to advise more on a products which are derivative linked products. Because more, whenever you link derivatives to your product, the risk in the product can move in any direction. It can enhance risk as well as mitigate risk, but understanding a product is very critical. So it's always better that if you get hand holding through a person who can guide you much better way about understanding how the strategy is getting implemented in SIF, that will help investor to take more better informed decisions in building his or her portfolio.
See, in mutual funds, you have got the direct and the regular kind of NAVs. People can choose to invest themselves directly or go through a distributor to build portfolios according to their risk appetite. Does SIF have similar structures?
Absolutely. SIF also has direct and regular plans. It also comes with growth and IDCW options. So SIF is typically a mutual fund product, but only thing, since it is a difference, it comes under a different branding because of the use of derivatives. Like in mutual fund, you call a product as mutual fund scheme, whereas in SIF, you will call all these products as SIF investment strategies.
I will ask you a question. You may find it difficult to answer this question because you stand on the other side of the fence. With the complexities that gets involved in SIFs, do you still feel that do-it-yourself investors have to check with the qualified advisors before they invest, or you pick up mutual fund just like you picked up a direct fund? If you cannot answer it for whatever the reason, you can say pass or give me an answer what your heart tells.
Definitely, sir. In fact, it would be better if investor takes the help of a guide in while investing in SIF, because products can be more complex. So it's better always, instead of looking at past performance and investing into a strategy, it's always better to understand what sort of a strategy I'm getting into and what is the road ahead for me, whether it is suitable for risk return trade-off which I am expecting from my investment. So it's always better that whenever the strategies becomes more complex, it's always better to take hand holding through from a good guide who can navigate my investment journey.
Mr. Niranjan, there are many investors who have ventured into different assets, what we described. They have mutual fund portfolio, they have got a PMS, they have got AF, some will not have AIF. If they have got these things, is there a scope or is there a need for them to venture it into this SIFs? Or you just say that, no, I've got other things, so I don't need to look at SIFs. How do you perceive it, the positioning of SIF in a client's portfolio?
Okay, so in today's scenario, wherein we have seen the rates on fixed income products have come, the YTMs on fixed income products have come up significantly. So, any investor who is expecting slightly better post-tax return, if he migrates from a fixed income product to a product like arbitrage, even the arbitrage role is risk-free rate plays a major role in terms of building up arbitrage role. So, as the risk-free rates have gone down in our system, even the arbitrage spreads have gone down. So anybody who is looking out to enhance his return much more than what arbitrage typical in today's scenario, typical arbitrage product may offer you return somewhere in the range of say 6.5%. If somebody is expecting at least 100, 200 basis more than that, but the investor doesn't want to face the volatility drawdowns which comes with a long only hybrid funds or equity funds, SIFs can help them to bridge this gap, because SIF products you can use derivatives to mitigate risk in a much better way. Say, for example, if a SIF product can use arbitrage as one of their strategies, there could be some more strategies like SIFs can use derivatives to build a covered call position. Now, what is a covered call position? Say, if I hold a stock at 100 rupees, I'm selling a call option on that stock, say at 103 rupees. So, whenever I'm selling something, I get a premium, so I have earned some income. So, just say, for example, if I earn 1 rupee as a premium income through this trade, then if the stock price closes at say 102 rupees, my gains are 2 rupees on a price as well as 1 rupee on a premium. But this strategy has some drawbacks. Now, what is the major issue with this strategy? If stock corrects, if there is some correction and the stock corrects, my downside risk is fully exposed. That's the way it happens with a long only equity portion. So to mitigate that risk, I can venture into one more strategy, which is called as protective put. Now, what is a protective put? It's typically a insurance to my holding. So if I have a stock at 100 rupees, I buy a put option say at 94 rupees, 95 rupees, 94 rupees. And when I'm buying something, I have to pay some premium. So say I pay a premium of 30, 40 paise to on this trade. But by paying that 30, 40 paise premium, I am protecting my downside risk of my investment. So, and when I combine these strategies, when I do a covered call and protective put, the strategy is called as collar. So when I combine these two strategies, I can build a collar around my holdings. So if I have a stock at 100 rupees, I can sell a call option and I can buy a put option. And by doing that, I can create a band in and around my position. So that's more of a safety net which gets built around my position. So wherein I can earn more of a price gain as well as premium gain and simultaneously protect the downside risk which happens in my investment. So this trade becomes little bit more aggressive trade than a typical arbitrage fund wherein you are just buying in cash market and selling in future market and plugging in those price gaps. So that's the reason these strategies could be more aggressive than a typical arbitrage fund. But since these strategies even protects your downside risk, they can be less aggressive than a long only hybrid funds or a long only equity funds.
See, one of the negatives of equity investment is, yeah, we discussed about volatility, prices being sudden sharp downside or sudden spike up moves. But another problem area of equity investing is markets may not do anything for long periods of time. They may remain sideways. Is there a possibility that the SIFs can do something of a positive in nature during a sideways market?
Absolutely, sir. So, like if you build arbitrage is one strategy which helps you in earning some money during. It's more of a risk-free sort of a strategy in a derivative space. Then you try to enhance this, and typically in the sideways market, strategies like collar strategy and all can help you to earn extra income by way of premium income by selling a call option. So when you do that, you get certain premium income. So even if your prices are muted, you can still make some gain through the premium income. So this is something which can even help you in a sideways market. So basically, a sideways markets and all are also good. So that's the reason it's very critical to know which strategy I'm entering into and how the derivatives are used in building this strategy.
Right. The world of SIFs is still in a very early nascent stage. People are debating, people are just checking what suits the most, confusion, and the regulators have also put restrictions on who can bring the SIFs and the restrictions on which fund manager can do it, the experience. They have done their part not to, overexpose the risk of derivative with each and every fund manager. Now at SBI Mutual Fund, I heard that you are the first one to come into the market with an SIF strategy. But I'm puzzled that you have come with a hybrid strategy. Can you, for the benefit of my viewers, take through your products what you have launched and the logic behind this? I know that over a period of time, more and more products will be rolled out, but why this hybrid strategy to start with? That too with a conservative mindset or conservative output to expect from that.
Great, sir. So why we came up, we launched our SIF under a branding called as Magnum SIF, and in the Magnum SIF we launched our first hybrid strategy, which is Magnum Hybrid Long Short Fund. Now, why we launch this strategy in current scenario? Because in current scenario, fixed income yields have come off significantly. So the low yields on fixed income asset, they are pushing investor to look out for some alternative avenues to earn income. Equity markets also are not providing enough confidence to deploy a huge lump sum allocation at a go. Taxation on fixed income is now less favorable because post March 2023, the indexation benefit which was allowed in debt fund, now we don't have any indexation benefit for that. And this is typically a time wherein investor is confused because if I have money, my fixed deposits are getting matured, my bond portfolio is getting matured, where I should deploy that money. If I go to deploy that, a post-tax return on the trade is relatively very low for investors. So there was a need for investor to look out for a product which can improve the post-tax return, but simultaneously doesn't have that higher risk, which is associated with hybrid funds which have a long only equity exposures or equity funds which are running a long only equity exposure. So that's the reason we tried to capture this space wherein on an investment ladder, the product which can fill the gap between an arbitrage fund and a long only equity hybrid fund. So that was a sweet spot wherein we have positioned our Magnum hybrid long short fund.
Mr. Niranjan, you brought this interesting concept of falling yields on fixed income, and you are trying to capture the sweet spot between the equity returns and the arbitrage. So, when the interest rates are falling, even a small improvement in yield will go a long way in helping people to get that required yields. But one question that lingers on is, how will the taxation of SIFs work? Can you help us understand the exact taxation that goes on in SIF?
Okay, this strategy which we have launched will be taxed as per equity mutual fund. So any investment less than 1 year, the gains would be taxed at 20%. More than 1 year, up to 1.25 lakhs per annum, there is no tax, and above that is 12.5%. So it's the same taxation what is applicable for equity mutual fund will apply to this strategy. So this strategy, Magnum hybrid long short fund, we will have minimum 65 to 75% in as a gross equity exposure, and we can have 55 to 75% covered equity exposure. So look at the beauty, your maximum cap of gross equity exposure can be 75%, and you can cover your entire 75% equity exposure in this strategy. We will have up to 0 to 25% unhedged derivatives, 25 to 35% in debt instrument, and 0 to 10% in rates and InvITs. So this is how this product will be structured, and due to this structure, this product will be eligible for equity taxation. So equity taxation means anything less than 1 year, 20%, more than 1 year, above 1.25 lakh, 12.5%. So the taxation for this would be exactly the same taxation what is applicable for equity or hybrid mutual funds with the equity taxation.
Are these strategies already available for people to buy into it now?
Yes, sir. This strategy is available for any investor to buy in. You can buy it on any business day, but the redemption or a switch is allowed only twice in a week. That is on Monday and Thursday. The reason being, these strategies are treated as interval fund. So whenever it is treated as an interval fund, for these strategies, you can have maximum two redemptions in a week, and we offer the maximum window, which is twice a week. So redemption or switch can happen on Monday and Thursday, but you can purchase it on any business day.
Niranjan, that's a lot of information. Before I let you go, your final words on what's that important advice you would like to give to the investor, as well as the word of caution before they consider buying SIF.
So generally, whenever we talk about SIF, what I hear from the people is SIF get more flexibility to use derivatives, and derivatives are risky, so SIF must be for aggressive investor. But this is not true because derivative can be used both to enhance as well as mitigate risk. Therefore, SIFs can be designed for aggressive investor as well as conservative investor. But every strategy would be totally different from other strategies. So you will have to be very careful in understanding the strategy and then taking your investment decision. So it's always advisable, if you're not well aware about all these things, take a help of your advisor and use this strategy in your portfolio, because this will fill those critical gaps which are there in your portfolio in laddering your investment or bucketing your investment across different asset classes. So these are very beautiful strategies because they come with a flexibility of AIFs with the tax benefit of mutual funds. So on a post-tax basis, these strategies can help in creating a very nice, robust portfolio for any investor. So please understand the strategies and use them based on your risk return appetite.
Dear viewers, SIF is an interesting world. It's an evolving world. It's a risky world. It's a rewarding world. See, this is one product where you can use all adjectives with it. So if you use it with caution, it can benefit for you. If it is used recklessly, then probably things may not work out in your favor. All possibilities exist. If you are somebody who is looking at investing in SIFs, you can make best use of services provided by NRI Money Clinic. Our team of experts who are licensed enough to advise you on the SIFs will help you pick up the right SIF, control your exposures, and make it work for you. So if you have an intention to use this, do drop us a message. Our WhatsApp numbers are there in the description box. We have provided a link over there. Click on the link, send us a message, SIF, and one of our team experts will get in touch with you to help you zero in on the right SIF for you. Why delay? Send that message right now. Mr. Niranjan, thank you very much for your time and courtesy to come on our channel, explain all these fine points around SIF. We and our viewers will remain in gratitude to you for all these inputs. Thank you very much, sir.
Thank you, sir. Thank you, everyone. Thanks for your time, sir. Thank you.
Dear viewers, hope this video that I have done helped you to understand finer points of SIF, what you should look for, what you should avoid, how you should handle it with utmost caution. If it helped you to understand all these fine points, do give me a thumbs up. Our channel grows only because of your subscription. Please do hit that subscribe button and press the bell icon right away. Do share these videos with your near and dear ones, friends and relatives, and on all the social media on which you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another topic, with yet another expert next Tuesday. Till then, stay safe. Jai Hind.
Press the bell icon for more details and subscribe our channel.